Welcome to the World News Updates channel, bringing you updates and events from around the world, from the most relevant to the most curious news. Stay tuned to our channel and never miss important news again. Following a surprise increase in inflation in February, the Bank of England has once again hiked interest rates by 0.25 percentage point. This is the central bank's 11th consecutive rate hike, pushing benchmark borrowing costs to 4.25%, the highest since October 2008. The bank's statement indicated that inflation had significantly exceeded expectations, while employment growth had been stronger than anticipated and household disposable income was expected to remain flat. The bank added that it would raise rates further if there was evidence of more persistent price pressures. UK consumer prices rose by 10.4% in February, the first rise in inflation in 4 months, due to increased food prices and rising costs for visiting restaurants and hotels. The Bank of England targets an inflation rate of 2%. Despite the current economic turmoil, the European Central Bank, the US Federal Reserve, and the Swiss National Bank have also raised interest rates in the past week. The Bank of England's decision to raise interest rates again comes in response to a significant increase in inflation in the UK. The central bank has been engaged in a long-running battle to rein in prices, and this latest move is part of its ongoing efforts to control inflationary pressures in the economy. With inflation rising at its fastest pace in many years, the Bank of England is taking steps to ensure that borrowing costs remain sufficiently high to discourage excessive borrowing and spending. Despite recent turmoil in the banking sector, the Bank of England is pushing ahead with its plans to raise rates. The bank has stated that it will continue to monitor credit conditions faced by households and businesses, but it has also emphasized the resilience of the UK banking system. With other major central banks also raising rates, the Bank of England's decision is part of a broader trend toward tighter monetary policy across the developed world. One factor contributing to the Bank of England's decision to raise rates is the recent surge in consumer prices in the UK. In February of 2023, UK consumer prices rose by 10.4% compared to the previous year. This increase was driven in part by rising food prices and higher costs for visiting restaurants and hotels. The Office for National Statistics has noted particular price rises for some salad and vegetable items, partly caused by shortages, which led to rationing by supermarkets. Despite the Bank of England's efforts to control inflation, some economists have suggested that the central bank may eventually be forced to cut rates. With the UK economy expected to shrink this year, and with lower energy costs set to drive a significant fall in inflation, the case for cutting rates could become stronger in the months ahead. Overall, the Bank of England's decision to raise rates is part of a complex and challenging set of economic circumstances. The bank is working to balance the need to control inflation with the need to support economic growth and stability, all against a backdrop of ongoing uncertainty and volatility in the global economy. Thank you for watching. Don't forget to leave a like and subscribe to the channel for more content like this.